Ladies and gentlemen, the program will begin in 2 minutes. Please take your seats. Again, the program will begin in 2 minutes. Ladies and gentlemen, the program will begin in 2 minutes. Please take your seats. Again, the program will begin in 2 minutes.
You know that there are 15 reasons why you should only bank at a credit union? This is Ron Draper from Somerville's Credit Union with reason number 2 and reason number 12. Reason number 2, your money is safe. No consumer has ever lost a penny in a credit union. Your account at the credit union is backed by the federal government and insured with the National Credit Union Insurance Fund. Credit unions have never been bailed out by the government or rescued at the hands of taxpayers. That's reason number 12. Credit unions practice what they preach.
Why settle when you can
Simply
have the
visit
best?
Better
I'm Bob
Value,
Gustafson, the CEO of Crescent Credit Union. When it comes to banking, be sure to check out credit unions. Year
Hi,
after
it's
year,
Eileen
the American
Danahy, the
customer
CEO of St. Anne's Credit Union. Do you have a checking account with a credit union? Are you looking to purchase a new
Morning
car?
show time,
or need a loan?
8:05.
Or
Time to
looking
talk about
refinance your
Delaware's
loan?
credit unions. We do this every couple of weeks. We bring you folks from one of the
everybody. I was going to open and see if people are excited about the Yankee win last night, but I don't know if I have the right crowd. Anybody excited? I know a few people are excited, so good. Well, it's great to have everybody here this morning. Welcome to the opening general session. We really have a terrific lineup for you today. 3 excellent speakers, I think, to get us off to a great start. So please engage, listen, ask questions. It's going to be a great opportunity for everyone. As you saw in this video, you saw a lot of things about advocacy. The core role of the Cooperative Credit Association is advocacy, and we really honor each of our 4 states. We do all our advocacy local. We're very passionate about that on the regulatory front, the legislative front. So that's very important to us. So with that, we want to start with the presentation of the flags of each of our states. So I'd like to introduce the flag bearer for the state of Delaware. That's Joel Romaine, representing Community Powered Federal Credit Union. Representing Massachusetts is Dave Lecuyer from Central One Federal Credit Union. Representing New Hampshire is Brian Hughes, Holy Rosary Credit Union. And representing Rhode Island is David Saval, Rhode Island Credit Union. Now, if everyone could please rise and remain standing for the presentation of colors, Pledge of Allegiance, and the National Anthem. Please give a warm welcome to the Mohegan Tribal Honor Guard as they present the colors. Join me in the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, liberty and justice for all. My pleasure now to introduce Kelly Schimmel from Navigant Credit Union, who will sing our national anthem.
Oh, say, can you see by the dawn's early light what so proudly we hailed at the twilight's last gleaming, whose broad stripes and bright stars through the perilous fight o'er the ramparts we watched were so gallantly streaming, and the rockets' red glare, the bombs bursting in air, gave proof through the night that our flag was still there. Oh, say, does that star-spangled banner yet wave o'er the land of the free and the home of the brave?
Estelle, thank you so much. Thank you. Thank you. Thank you. Let's have another round of applause for Kelly and the Tribal Honor Guard. Okay, great. Okay, please be seated. So we start this morning. I'm honored to have the NCUA Chairman, Mark McWatters, with us this morning. As you guys know, as good members of the Cooperative Credit Association, we spend a lot of time and resources looking for regulatory avenues that will make your lives a lot easier running your credit union. And we spend a lot of time advocating with NCUA. I think the chairman will get into it, but we have a tremendous number of things happening at NCUA that are important to all credit unions, whether you're state or federal. The biggest recent news was the merging of the Corporate Stabilization Fund with the National Credit Union Share Insurance Fund. Everyone's getting a dividend back next year, I think, right, Mark? Dividend next year? Dividend, right? Dividend next year? Yes, a dividend next year. So we've had a lot of exciting news coming out of the agency, but there's still a lot of questions about what the direction will be and what comes next. So we're honored to have Mark McWatters with us. He was named as chairman by President Donald J. Trump on June 23rd, 2017. He has been on the board since 2014. He brings a market-oriented, transparent, and fully accountable regulatory perspective to the board. He has more than 30 years of legal experience as a tax, corporate finance, and mergers and acquisitions attorney. He has worked both in federal government and state government, the private sector, and academia, and has significant experience in public policy issues related to the regulation of financial institutions and alternative investment vehicles, including service as a member of the Troubled Asset Relief Program Congressional Oversight Panel. Mr. McWatters is also licensed as a certified public accountant. Please join me in welcoming Mark McWatters. Thank you, sir. Appreciate it. Yeah.
Okay, Paul, you left your notes up here. And okay, so I'll just continue here. I think we're dismissed. The margarita machines have been brought in, and tea times will be distributed. And is there anything else I've missed here? Jeez. Okay, let me get organized here. I have sort of a small change in my life, which I'm trying to deal with. And that is something that some of you may be familiar with, and this is it. And they're known as reading glasses. And so I am not quite acclimated yet, kind of like putting a collar on a dog. You know, I don't know. Well, thank you, Paul, for the kind introduction. And more importantly, thank you for what you do for the credit union community. Your advocacy, not only at the federal level, but the state level, not only with NCUA, but with the what's that other agency, CAPB, I think that's what they're called, is far beyond the 4 states that are represented here. Paul cast quite a shadow over the entire credit union community. What he has to say, what you guys have to say from this group is heard throughout the country. And I appreciate that. I appreciate the leadership, Paul, that you have shown. I think I will start this morning by talking briefly about something that we did at the last NCUA board meeting, and that is the merger of the Temporary Corporate Credit Union Stabilization Fund into the National Credit Union Share Insurance Fund, and why we did that. A year or so ago, Sarah Vega and I, Sarah's my chief of staff, we were called into a meeting where we were briefed on the equity ratio and what was going on with the equity ratio. As many of you know, equity ratio is a fraction, hence a ratio, with a numerator and denominator. The problem is that the denominator of the fraction was growing, the numerator was not growing quickly enough, and we all remember from, I don't know, 3rd grade math. I mean, it was probably more like, I don't know, 10th grade math. But if you increase the denominator of a fraction and you decrease the numerator, the fraction decreases. The fraction goes down. So we had an equity ratio that was set at a normal operating level of 1.30, which is what the equity ratio should be. But right now it's around 1.25, and it's gliding down, okay? I mean, years and years ago, before I had children, I used to fly sailplanes, okay, these German gliders. The thing about German gliders, they don't have engines, okay? So when you would go from base leg to final, you were going down, okay? There was no engine. You were going to land, it was going to be a nice landing, or it was going to be an unnice landing. Same way with the equity ratio, on a glide path, going down, dropping. Now, what did that mean? What it meant was that sometime in 2018, perhaps 2017, but 2018, I feel for sure, there would be a premium assessment to the credit union community. And that premium assessment would mean you would have to do something that you don't want to do, and that is take out your checkbook and write a check to the NCUA. And that check would be anywhere from 6 to 8 basis points, okay? 6 to 8 basis points, check to be written. So I looked at that and I thought, okay, well, I mean, I guess if that's the way things are, that's the way things are. Except I was perplexed because there were two funds, right? There was the Share Insurance Fund, which had this equity ratio on the glide slope going down, but there was also the Stabilization Fund. The Stabilization Fund was set up, as everyone knows, to handle the corporate credit union debacle in 2007, 8, 9, and 10. And the Stabilization Fund met with some unexpected, unanticipated positive events. The lawsuits initiated by the NCUA had collected a net amount of around $4 billion, which went into the Stabilization Fund. There was a gross amount of $5 billion, but we way overpaid lawyers $1 billion in legal fees. So there was $4 billion left. That helped a lot. That was the source of the funds. What was the use of those funds? Principally to repay the $5.1 billion debt to Treasury, okay? That's good, right? Because if that money was not used to repay Treasury, the money would have had to come from somewhere, and I got a feeling I am looking at the people that would be writing yet more checks. But you didn't have to write those checks because of the success of the lawsuits. Also, the underlying assets securing these NGN notes that were issued by the Stabilization Fund or through mechanisms of the Stabilization Fund were actually appreciating in value. It's like those of you who are in this room who are old enough like me to remember the S&L crisis, the dot-com crisis, the LBO crisis, the lesser developed country crisis, any number of energy crises, is that assets tend to recover. And that's what happened with respect to these dubious assets the corporates bought and that tanked in 2008, around September 2008, Lehman weekend, AIG debacle, and the like. They were coming back. This is a good thing. So we could sell those assets as permitted at a greater amount than we were valued them going in to secure the NGNs. It's all good stuff, all good stuff. So my thinking was, why instead of asking you to write a check for the 6 to 8 basis points on the glide slope of the equity ratio going down, why can't we just tap into the stabilization fund? Because it appeared that we had excess proceeds there. What? From where? Again, litigation recoveries in the value of the assets, and profits from selling some of the assets. So why can't we tap into that? And being a deal lawyer, transactional lawyer, I thought of ways to do that. And the easiest one would be to just to sort of borrow some funds out of the stabilization fund. Simple debtor-creditor relationship. Well, the lawyer said that did not work. Okay, well, if it doesn't work, what's plan B? Plan B was, can we just combine the funds? Can we combine the stabilization fund into the share insurance fund and take that excess and now drop it in the share insurance fund? And if you put it in the share insurance fund, you take away this deficit in the equity ratio downward sloping glide path. And the answer was, well, you really can't do that, or it's a real pain to do that. And I said, wait a minute. In 2021, when the last NGN notes come due, we're going to have to get rid of this stabilization fund. It just can't stay out there forever. We have to get rid of it then. So if we have to get rid of it then, why can't we get rid of it now? So we hired 50% of the final 4 accounting firms, final last 4 of the big 8 when I started practicing accountancy years and years ago. And they looked at it. We retained lawyers. They looked at it. We retained BlackRock to look at it from a financial modeling perspective. And they came to the conclusion that, yeah, you actually can combine these 2 funds together. You can do it legally. You can do it within the accounting rules. And BlackRock will tell us the risk involved in doing that. So we proposed to do it. We put out a notice of comment, which we didn't have to do, by the way. There was no requirement that we go to the community and ask for comments. Instead, you know, my view is more comments the better, more transparency the better. So we went out for comments, received comments, and voted at the last meeting to consolidate the stabilization fund into the share insurance fund. So far, except to, I think, a few people, nothing I've said is particularly controversial. Why? Because I'm trying to solve a problem. And the problem I'm trying to solve is to keep you from having to write a check. Why can I keep you from writing a check? Because there's extra funds over in the stabilization fund. Next point was, okay, so we combine the 2. We say to you, you don't have to write a check. Then the question arises, well, if by chance do we have extra proceeds where we can pay a dividend? We can pay a dividend in early 2018. And that question is answered by 2 numbers. One is, on a combined basis, what is the equity ratio of the share insurance fund post-consolidation? And you run the numbers on that, and it looks like the combined equity ratio is somewhere between 1.45 and 1.47. Okay? That's a huge number, by the way. Okay? Right now we're at 1.25, or at least pre-merger we're at 1.25. Post-merger we'd go from 1.25 to 1.45 to 1.47. Big deal. Big deal. Given that the normal operating level is set at 1.30. So all of a sudden, we not only did you not have to write a check, there was a legitimate argument that a dividend should be paid. But in order to pay the dividend, not only do we have to know the 1.45 to 1.47, we have to know what the normal operating level is. So we went back and we computed the normal operating level. And this is where the controversy with some has arisen. How did we compute that normal operating level? Well, I looked at the then current normal operating level of 1.30 and discovered that it was set in 2007. Why is 2007 important? Well, 2007 is pre-recession. In other words, the NCUA board established a normal operating level of 1.30 using methodology that was pre-recession. So in other words, we learned nothing from the recession. We learned nothing from this great downturn in the economy, only eclipsed by the Great Depression in the late 1920s and 1930s. Surely we learned something from the Great Recession. So we took the new methodology. Is it my methodology? Is this something that I invented? Is this something Sarah Vega invented? We were just sitting around saying, well, we do it this way. No. It's not my methodology. It's not hers. It's not NCUA's. We went to the Federal Reserve Board of Governors, stress test, macroeconomic assumptions post-recession. We took their rules. We took their thinking. We worked those rules into a credit union model, but the base macroeconomic assumptions are from the Federal Reserve Board of Governors. Why did I do that? I wanted to be objective, be absolutely objective. I wanted to be objective to you, but also wanted to be objective to members of Congress, because people will come knocking on my door and saying, hey, what are you doing here? You know, how did you come up with this number? Okay? I want to be able to point it back to something that I did not simply invent out of whole cloth. So we took the Federal Reserve Board of Governor methodology. We, in effect, stressed the share insurance fund on a post-recession approach and came up with a baseline normal operating level of 1.33. Okay, pre-recession methodology, it was 1.30. Using post-recession, it just bumped up 3 basis points to 1.33. What was the key assumption in going from 1.30 to 1.33? We assumed a moderate recession. We took the Federal Reserve approach. Well, we took their approach for a moderate recession. If we would have taken their approach for a severe recession, what does that mean? A recession like 2008, 2009. If we took that approach, the baseline normal operating level would go from 1.30 to 1.41, okay? Just baseline. So we had to make a decision. Are we going to set the normal operating level based upon a moderate recession or a severe recession? Well, severe recessions don't happen that often. Moderate recessions happen on a regular basis. Well, how about splitting the difference? How about being a little more conservative? How about going from 1.33 to 1.41 and coming up with something in between? Well, the thinking was, at least my thinking was, that seems a bit arbitrary. It seems like the best approach is to go moderate recession or severe recession. Severe recession, again, is not exactly a 100-year flood, because after all, we've had very, very bad economic downturns in this country, too, within the last 100 years. So I couldn't say that severe made no sense, but the best approach to me was to set it by a moderate recession. So the normal operating level, base case, post-recession, Federal Reserve Board of Governor, macroeconomic assumptions at 1.33. 1.33. Okay, you've heard the number 1.39, and I just said 1.33. So how did we get from 1.33 baseline, you emphasize the word baseline, normal operating level, to 1.39? In other words, 1.33 to 1.39, there's a difference there of 6 basis points. What does that consist of? What's our logic for that? Well, remember what happens when you combine the stabilization fund with the share insurance fund, okay? You're taking a pristine fund, the share insurance fund, which is jam full of, I don't know, $13 or so billion worth of assets that are invested in treasuries, very, very low-risk securities, okay? And then you're taking assets, investment assets, that are sold in the marketplace that are risky. These NGNs are far, far, far riskier than the assets that are in the share insurance fund. But now you're combining them together. You're truly mixing apples with oranges, and that can be dangerous. Why is that dangerous? What's the problem with doing that? Because if there is a moderate recession, bad stuff is going to happen to the NGNs that is not going to happen to the T-bills and notes and the other treasuries where the share insurance fund assets are invested. So when we took the NGNs in and dropped them into the share insurance fund, along with the NGNs came the collateral that was securing them. Okay? These are securities sold in the marketplace. They have designated collateral securing them. Now remember, NCUA is contingently liable on this. So if the collateral proves insufficient, we have to make up the difference, which means ultimately you have to make up the difference. So when you combine the two, the question was this: what if there's a moderate recession? What happens to the collateral that's securing the NGNs that are outstanding, that will be outstanding till 2020 or 2021? What happens to that collateral in a moderate recession? Well, guess what? It goes down in value. I know that's a real shock, right? It falls in value. Why? Because that collateral is nothing more than real estate assets. Moderate recession, real estate goes down. It goes down, the speculation was, it would go down enough where it would not be sufficient to repay the principal and interest on the NGNs. In other words, there would be a shortfall. We would have to make up the shortfall. So we went to BlackRock and we said, model these NGNs, model the collateral that is securing the NGNs, model it using Federal Reserve Board of Governors post-recession methodology, macroeconomic assumptions and the like, and then tell us, if there is a moderate recession, how much this collateral that's securing the NGNs is going to drop in value to where the NGNs are underwater. Because we know we're going to have to make up the difference. And BlackRock came back and they said, under a moderate recession, that collateral is going to drop such that you're going to be 4 basis points shy, meaning you're going to be around $400 million short, meaning $400 million is going to have to come out of the share insurance fund or somewhere to make up the difference so you can repay the NGN investors as their notes come due. $400 million, 4 basis points. Each basis point is around $100 million. So we took the normal operating level, baseline, base case, which went from 1.30 to 1.33. Now we needed to add 4 more basis points to it. Why? Again, moderate recession. What happens to the underlying collateral in the NGNs? Falls in value by $400 million. Someone has to come up with $400 million so the NGN investors can be repaid in full in cash as their notes come due. So by adding that extra 4 basis points to the normal operating level, by putting an extra $400 million into the share insurance fund, we know now that if there is a moderate recession, then we're not going to have to come knocking on your door, okay? Not going to have to come knocking on your door to write a check for the shortfall. So in other words, we are reserving against a moderate recession. So, well, you may think, well, you know, what if there's a severe recession? A severe recession, BlackRock told us, is that the underlying collateral, the collateral securing the NGNs, would fall by around 11 basis points. You multiply 11 times $100 million, you get $1.1 billion shortfall. Okay, but we're only reserving for $400 million, not $1.1 billion. Why? Because it seems reasonable and prudent to do that. And if there is a severe recession, if there is a repeat, a relapse, if you will, into 2008, again, we will address that at the time. But I think that reserving the 11 basis points as opposed to 4 basis points was a bit too much. So that takes us to a normal operating level of 1.37. And you may ask, well, what if there's not a moderate recession? What if there's no recession between now and 2021? And the NGN notes are able to be repaid from the collateral that is currently securing them. In other words, there's no shortfall. There's no makeup required. What happens to that 4 basis point difference? Well, this will be in 2021. I will not be a member of the board. I'll be a distant memory. I'll be gone for quite a while by then. Hopefully, I would think that the NCUA board at that point in time will say this additional 4 basis points was a contingency. You know, the record shows this at the meeting last month. The record shows this is intended to be a temporary increase in the normal operating level. And hopefully the board then will go through, reevaluate the normal operating level, determine that it's 4 basis points too high, or 5 basis points too high, or 3 basis points too high. Whatever it is in 2021, I can't see that far in the distance. And then pay the balance out as a dividend then. But until those NGN notes are repaid in full in cash, principal, interest, everything else, it's prudent to reserve the 4 basis points for a moderate recession. So again, that gets us from 1.30 to 1.33 to now to 1.37. Okay, how do we get to 1.37 to 1.39? Where did those last 2 basis points come in? Why is the normal operating level not 1.37? Why did we set it? Why did the board set it at 1.39? Well, again, the equity ratio is on the glide slope down. Again, it's on the glide slope down because the denominator of the fraction is increasing. The insured shares in the credit community are increasing because of your success, because of what you're doing. You're increasing the denominator, the numerator, because of particularly the retained earnings component is earning interest at low rates. T-bill rates are low on $13 billion of assets. So glide slope goes down. We ran the models, and it looks like over the next year or two, or maybe a little bit longer, the equity ratio just naturally will deteriorate by 2 basis points. So we just made the decision that why don't we reserve for those 2 basis points now, and then as the equity ratio glides down, we're not going to have to come to you to write a check. So we're reserving for what we think will happen in the future with respect to the equity ratio on the glide path down. So I hope that helps explain what we did. Let me offer a couple of other observations. Some people have said, and they've said so quite stridently, that the normal operating level of 1.30 was hunky-dory. It was fine. It did the trick during the Great Recession of 2008, 2009. It really did not. It was quite inadequate. If you consider what happened with the corporate credit unions, with the stabilization fund, the equity ratio would have been driven down from 1.30, which is what the board had set as a normal operating level, would have been driven down to around 0.31. Okay? If there had not been a stabilization fund, meaning there had not been the $5.1 billion borrowed from Treasury, if there had not been the assessments of $4.8 billion from the credit union community and the like, the equity ratio would have fallen to around negative 0.09. In other words, wiped it out. Wiped the equity ratio out, even driven it negative. So to say, 1.30 was sufficient is at odds with the facts. Some people say, and I understand this, hey, the corporates are fixed now, right? I mean, they had some investment authority which was inappropriate. They made the same mistakes as just about everyone else did on Wall Street. The reason for the TARP bailout program and the like, where some bad investments are made, not by just the corporates, but by Wall Street across the board. And so that's been fixed now. So why do we have to relive the past and worry about the past, because if it wasn't for the corporates, the 1.30 would have been sufficient, right? You know, it would have been okay. Everything would have been okay. Corporates are fixed. Let's not refight the last battle. Well, unfortunately, that's also at odds with the facts. The natural person credit unions alone, natural person credit unions, setting the corporates aside, natural person credit unions, because of losses there, would have taken the equity ratio from a normal operating level of around 1.30 to an equity ratio of 1.07, which is the reason you received a 23 basis point assessment a few years ago. So even natural person credit unions caused the equity ratio to drop precipitously. Now, when I say cause, remember, I'm talking about an indirect effect here. No one is saying, I'm certainly not saying that credit unions, natural person credit unions, did a poor job in underwriting mortgages. They did not. To suggest otherwise would be contrary to the facts. But what happened? Why did this happen? Well, in a strong recession, your members, I mean, you know this, I'm preaching to the choir here, I think, your members lose their jobs. They get cut back on their hours. These are working class people. Lose a job, lose some hours, lose half a job, one spouse loses a job. All of a sudden you can't make the mortgage. The mortgage was prudently underwritten, but it was underwritten assuming someone was working. And if someone is not working, that's a problem. Same way with car loans, same way with other loans that credit unions had. So that's how credit unions principally suffer from a recession. It's not so much the underwriting was not prudent. It's just that recessions have bad effects on people. Causes people to have less cash flow, less ability to pay their obligations as they come due, as they did with you, which led to losses in credit unions, which required NCUA to write checks. We wrote a lot of checks that drove the equity ratio down 23 basis points, which required a replenishment by the credit union community in writing checks to do that. Also, one other point is without the $4 billion of net legal recoveries, all of this would have been theoretical. I don't think anyone at the time, at least when I was not around, but what I've been told, no one at the time really expected legal recoveries to amount to much. No one really expected that we would someday be in a situation of saying, here's some money back. Okay, it's been a dramatic reversal of fortune, all of which is good. Last point on this area is the FDIC. The FDIC has an equity ratio equivalent not of 1.39 but of 2.0. Okay, that's their aspirational goal. That's where the FDIC has announced that they're heading to. We at NCUA are capped on our equity ratio, our normal operating level, at 1.50. So we can't go to 2.0 even if we wanted to, and I'm not suggesting we do at all. But it's just interesting to compare these two insurance funds where the FDIC is looking at 2.0 and NCUA is at 1.39. Also, the FDIC raises 100% of their equity ratio through premium assessments. 100%. I mean, every year, I don't know how many basis points, say 10 basis points, every year from the banks permanently go in to the FDIC insurance fund. It's deduction, an expense for the banks. It hits their capital currently. The 1% posting credit unions make is treated as an asset on your books. It does not currently flow through P&I. It does not currently hit capital. It's an entirely different paradigm over the FDIC. And I think the NCUA model works, and I'm not suggesting that NCUA parallel what the FDIC is doing. Why don't I stop here for a second? This is a lot to digest. I know a lot of you have heard this before. Some of you have heard it before from me, but maybe we ought to just open it up for questions on this particular topic before I move into something else. And again, the topic meaning the merger of the stabilization fund into the share insurance fund in the resetting of the normal operating level from 1.30% to 1.39%. I will take questions from everyone but Gene Foley.
Thank you, Mr. Chairman. When you were going through these calculations, what influence, if any, did the taxi medallion loans have on thinking about the risks to the fund?
That's a good question. The taxi medallion loans, right now, our reserves for all losses to the share insurance fund, which would, of course, include any contingent liability with respect to taxi medallions, it's not my number. Okay, I don't look at this and say, maybe we ought to reserve this or that. This is all set by accounting rules, GAAP rules that are go through our CFO, they go through our inside auditors, and then the outside auditors too. So we're following GAAP, and everything that needs to be reserved, as far as GAAP is concerned, has been reserved. Am I concerned that there is a possibility that there could be additional losses in the future? You know, yes, I am. But to get to the point of saying, let's take the net, the normal operating level up above 1.39 to capture those contingent losses, I can't justify that until the GAAP accounting numbers and the auditors and everyone signs off and says, we're going to book a reserve here, then I can do that. But until then, I think it's best just to leave it where it is. But yes, Gene, we're thinking about it a lot. Yeah. Yes, Jim.
First of all, I just wanted to thank you for laying it out and explaining it. I'm not sure that everybody agrees with the exact numbers, but understanding the logic, I think, is very beneficial. Second question, a little bit separate from the merger piece of it, but you talk about the numerator and the denominator. Are there opportunities, and I'm not talking about getting into junk bonds and things, but is there an opportunity to perhaps look at enhancing the return without taking on a significant amount of risk with regards to the fund? I mean, as I understand it, they're all pretty much laddered treasuries. Mm-hmm. And I don't know if that was something you were, I don't know if you wanted to get in, but is there an opportunity? I just think that that might be a value as well, kind of longer term. It's almost impossible. We follow Treasury guidance on this. There's really not much of. There's really not much leeway we have in this, and the Treasury guidance says you can't do anything that looks like you're timing the markets. If interest rates are going up, you can't run that calculation and reshuffle the ladder accordingly. And going to assets that are different from treasuries, I mean, you can imagine the hue and cry if we were to, even if permitted to, which we're not, invest in something with a higher yield and then go into a recession and that blow up. And, look what these people are doing over at NCUA. What do they think NCUA is, a hedge fund? Where did they get that expertise to do that? So it's a tricky deal. Yeah, I guess my one thought is even beyond like agencies or other things that aren't huge risk. But. Sure. Okay, thank you.
one more over here.
Again, I want to compliment you for laying it out, the whole calculation very clearly in a language that we can all understand. I very much appreciated that. One question, I guess, if the 4 basis points is related to the repayment of the NGNs, can we not exclude that from the base operating level and call that a contingency so that 3 years from now we're not relying on the wisdom of a future NCUA board to make that repayment or that dividend? Can we legally call that a contingent versus including it as the base operating level?
It's a good question. It's a question that I ask too internally, and the answer goes something like this. Under the Federal Credit Union Act, if there is a normal operating level at, say, 1.30, anything above the 1.30 has to be dividended out. Okay, you cannot, when you get above 1.30, you cannot take the excess and simply add it back in. If the normal operating level was set at 1.25, then there was excess there, you could add it in to get to 1.30. So the only way we can do this is to call the 4 basis points part of the normal operating level and set the record as straight as we possibly can. And I think former Chair Metzger and I did that, and hopefully the future NCAA boards will look at that and decide, yeah, this was a contingency and it should be paid out now. Going back to what Gene said, though, this is a dynamic process. There may not be a loss on the NGNs. The BlackRock number, the BlackRock reserve, if you will, of 4 basis points, may never come to pass because there's not a moderate recession. Or it's less than a moderate recession. It's a teeny weeny recession, so it only eats up 1 basis point. So there's 3 basis points left. Well, if the tax medallions come along and we end up writing a $300 million additional check on them, guess where those 3 basis points go? They go to the taxi medallions. If then we have a recession on top of that and we're unprotected on the NGNs, then we're back to a new day. But hopefully the 4 basis points will be enough to take care of whatever recession occurs with respect to the NGNs. Less recession occurs. Let's pay it out in 2021 unless we need it for something else. The point behind this is to be prudent enough to allow you to manage your businesses without always having to think, oh my gosh, I'm going to have to write NCUA a check. As I know from 30 years of representing clients, that's a tough thing to do. It's a tough thing when clients come to you and say, what do I do? How do I handle this? So we're trying to be a little bit prudent on this.
We'll do one more on this one.
Okay.
Mark. One more.
Just a quick question on that 4%. Is it a cliff, or as we approach 2021, is it a gradual decline? So if we're looking at 2019 or 2020, does that gap go from 4% down to 3%, down to 2%, allowing a possibility of a return of a dividend prior to the cliff of 2021?
Yeah, it's a good question. It is not a cliff, because as every one of those NGNs matures, that contingent liability with respect to that NGN goes away. So when BlackRock did the model, they built into the 4% some of the risk with respect to that NGN that just now matured, and the underlying collateral was sufficient to pay it off. Okay, it's a good question. So the problem is that most of these outstanding NGNs come due in 2020 and 2021. So in that respect, it's sort of a cliff because it carries on pretty stable till 2020 and 2021, with the biggest maturities, I believe, coming in 2021. But yeah, that's a good question. So, but to follow through with the next question, I know you have to be thinking, is that if along the line enough of these mature to absorb that part of that 4% contingent liability or contingency built into the normal operating level, wouldn't it be prudent to pay a dividend earlier rather than later? Why wait till the very end in 2021? And yeah, I agree. If I'm on the board at that particular point in time, by all means. Unfortunately, that was going to happen in 2020 and 2021, and I will not be on the board.
I lied, Mark. We have one more on this topic. Hot topic, so one more question.
Good morning. Jeanette Schuler from Dover Federal Credit Union. So it seems with that 4% and sort of being maybe a staggered cliff, the 2%, just because of the natural glide, it would seem that that would be a bit of an overcompensation because you've had to bring the baseline. And I would think you would stay at the 1.37. Then when you get to 2021, you'd be able to figure out the difference and if anything would be due back to the credit unions. So it just seems like it might be a little overcompensating and bringing it up to 1.39, and maybe it should just stay at 1.37?
Yeah, we had those discussions within the agency. I mean, there's an argument to be made that going from 1.37 to 1.39 is a bit paternalistic, right? It's like, you know, this thing's going down, and so why don't we just send you a bill as it glides down, as opposed to just reserving. But from talking to people and getting a feel for this, there's a general irritation factor of having to write NCUA a check. And so 2 basis points, given that the natural glide path will eat that up in short order, seemed to be a prudent thing to do. But I agree with you. I think it's a much closer call. I think from taking the normal operating level from 1.30 to 1.33 based upon post-recession approach, a no-brainer. Taking care of the contingent liability and the NGNs outstanding today under a moderate recession is a no-brainer. Going those last 2 basis points, I can understand the subjectivity to that and the view that people say, well, just send me a bill. Just send me a bill, and I'll write a check then. So I get your point.
Just for the record, before we move on, the Cooperative Credit Association strongly supported the NCUA's plan. We believe strongly in it. We're often very critical of what the regulators are doing. This plan, I thought, made a lot of sense for our members in terms of not having to have the assessment, getting a check next year. As far as 1.39 to 1.37, I guess we could argue about that. But we thought it'd be prudent to have that buffer, that ability, especially with things going on in medallions, potential recession and that. And further, we are going to be focused on, and Chairman McWatters knows this as well as Sarah does, the budget of NCUA, because all of these discussions come down to the budget of NCUA. If the budget of NCUA continues to normalize and flatten out, we're going to have more ability to get money back. And I know the budget's a big issue. I was wondering if we could move on to the budget now, Mark, because we have an open hearing on the budget next week. Could you give us a little perspective? A lot of credit unions just see it this simply. Paul, the number of credit unions are going down. Why is the NCUA budget, continue going up? And that's a very simple thing, I know, but that's what you hear. So what do you say to just the obvious thing of the number of credit unions going down? Do you need as many examiners in the field? You're passionate about the virtual exam process and getting less examiners on site. How will that affect the budget, and what do you see for the budget going forward?
Yeah, the NCUA budget is continuing to creep up a bit. And so when I got to the NCUA board, I thought, we need to look outside of 1775 Duke Street. We need to get feedback from the community. Because 70% of our budget is people, and basically examiners, and around 10% is travel, principally examiners. So a chunk of our budget is doing something that the truth of the matter is you guys know as much about as we do. So what can you tell us? I asked for a budget hearing the first 2 years I was on the NCUA board and was voted down on that. Again, the budget hearing was not a novel idea. It happened before. I just thought it was important since we're using your money to get your input. Simple process. It doesn't mean that you are going to come up with any novel, brilliant idea, or that I'm going to come up with a novel, brilliant idea, but maybe if we talked, maybe even talked a little bit formally in an open hearing, it would be of some benefit. Honestly, Paul, what I found from the first budget hearing last year, it wasn't as helpful as I would have hoped. Okay, as far as novel, new, creative ideas, they were not as forthcoming as I would have wished. So what have we done in the interim? Just as threw our hands up and said, no, there's nothing we can do about it. Well, actually, no. One, we announced a couple, 3 months ago about closing 2 regional offices. I don't think this has ever been done before, 2 regional offices at one time. This wasn't just let's close regional offices to save some money. Okay, this was to close regional offices that we really don't need, that we can structure around efficiently. There are fewer credit unions. There's less and less of a need for as many people to be on the road, particularly going to the smallest of credit unions. So closing 2 credit unions, but even given the way the federal government works, the closing will not be effective until January, totally effective until January 1, 2019. But at least the bureaucracy is set in motion to accomplish that. Also, other things such as virtual examinations. I mean, there's a lot of talk about virtual examinations, but it would seem to me that it would make sense that if we can examine your credit union from someplace other than your credit union, so we don't have the travel expenses, and we also don't have the day-to-day disruption of you trying to serve your members with a credit union stuffed full of NCUA examiners, or in some cases, CFPB examiners. Now, virtual examination is a great soundbite. Sounds good. What does it mean exactly? How does it actually work? Because it's not just distance examination. It's a way of examining by looking at other metrics that are out there, looking at risk from a different perspective. So, what would the private sector do when someone has an idea? And this is not like I dreamt this up myself, okay? This is the collective wisdom of people talking together within the agency and also talking to people outside the agency, meaning talking to people like you. Well, what you do in the private sector is you develop a bit of a think tank. You develop a bit of an R&D shop, and that's what we're doing. We're hiring in some people to think this problem through. We're spending a little bit of money in hopes of saving a lot of money in the future. Is it going to be next year, the year after that? No. No. We're trying to lay the foundations for something that will be a benefit several years down the road. You know, Paul, we're doing simple stuff. The 5300 call report seems to be a needless pain, anxiety to people. You know, can't that be simplified somewhat? And yeah, we're doing that. We are taking leases, property that we've leased, and we're consolidating offices together. I know in Austin, we had a lease facility, and we also own a facility in Austin. So we let the lease run out, and we're moving people over to the owned facility and then consolidating some of the back office functions, accounting and law and the like, into Alexandria, trying to make it more efficient. Now, saving the money on that lease is not the biggest number in the world, but, you know, it's a dime here, quarter there. It adds up after time. So, does that help?
Yeah, I think that's great. I think, Mark, the other thing I'd say is, you know, a lot of credit unions don't look forward to their exam, obviously, right? It's a burdensome process, takes a lot of people away from their daily jobs. But one thing I do hear from credit unions is the specialists that NCUA have, whether they be MBL specialists, capital market specialists, whatever it may be, they bring value to an exam process that a lot of credit unions embrace, say, boy, we're learning things, or this is helping us at the credit union. You ever see the day where the specialists will drive exams, where you're actually helping the credit union in terms of seeing their business better, rather than the gotcha approach of, we found this little thing wrong and this little thing wrong? More of a, I don't want to say consultancy type, but more of a partner to the credit union.
I would hope so, Paul. I would hope that it's headed in that direction. I mean, I've sent the message from my office that the gotcha approach, I don't like that. I don't like people to do that to me. You know, I spent years as a lawyer, years as an associate lawyer in law firms and partners in law firms and stuff like that. It would have people do that to me. I didn't appreciate it. And I can't imagine that someone who's trying to run a business, serve your members, and that's the response, is a gotcha over stuff that is just de minimis, stuff that just, let's take a step back. Does this really matter? Is this truly a safety and soundness issue? Aren't there other ways to articulate that in a way? I mean, this idea that people have to come and examine and have to find something to justify the reason for being there doesn't really work with me. And so when Sarah and I hear about the gotcha approaches, we're pretty prompt in addressing those.
Great. So, want to open it up for Q&A now before we wrap here? Is there anything else you want to just drive home before we do that?
Yeah, but there's one other point. There's been a lot of energy focused on this merger business of this stabilization fund, the share insurance fund, and hopefully that has run its course now. I mean, there will be people that will continue to have questions on that. We got a lot of other stuff going on at the agency. I mean, we enacted a new member business lending rule a few months ago, a year ago or so. We were sued by the ICBA. Federal court threw that out. We finalized a FOM rule. We were sued by the ABA. That's proceeding in federal court. We have another FOM rule proposed. Look, folks, I'm a lawyer. I've been a lawyer a long time. I work around lawyers. Lawyer, I don't know, 35 years. I don't know how in the heck that happened. Sarah's over 25 years of being a lawyer. I mean, we read the Federal Credit Union Act carefully. We have reputations here. Okay? I read the act. Can we do this legally within the Federal Credit Union Act? My response to an MBL was, yeah, and the federal court agreed. My response to an FOM, the one that's finalized, the one that's proposed, was, yeah, we can do that. We'll see what the courts say. We also have a rule pending on corporate credit unions. You know, I understand that some of you wrote a lot of big checks with respect to corporates. It's not 2008, it's 2017 now. The world has changed. Corporate credit unions have changed. And we've made some proposals. I think they're entirely reasonable. Our comments back on those were fairly benign. So hopefully that's a rule that we will go forward with. We have appeals rules. What does that mean? Well, I'm a lawyer. Due process matters. If I'm a credit union and I have issues with respect to an examiner, you know, it's just natural to be a little bit concerned about retaliation and the like. I mean, I find that absolutely offensive, but also I've spent enough time in the real world to know that's a practical, real-world concern. And so I wanted the appeals process changed within NCUA to make it more open, more transparent, make it in a way where you could bring your lawyer, you could bring your CFO, you could bring your CPA, you can bring anybody you want to, you know, bring your Uncle Fred for all I care, you know, to the meetings and state your case and have a time limit, time frame to response back to you and resolve these matters.
So Mark, can we just, before we wrap, just 1 minute on the voluntary merger rule, because I think a lot of credit unions don't understand why this happened. If you guys don't know, the voluntary merger rule requires, if there's a merger, that you have to disclose certain compensation that the merged credit union executives may be getting in the transaction. So there's a process where it would be disclosed to the membership, not unlike if you convert to a bank, you got to disclose to the members. So some said, why is this going on? Is there a problem in the industry? Do you see that credit unions are buying out credit unions? It's a terrible term to use in a cooperative system. That's more in a banking system. But what spurred this rule? Did you see transactions that raised your eyebrows and said, boy, this is not very credit union-like? Isn't it just up to the boards if they think it's okay? That's good. They're elected by the members. Just give us a little background why you thought this rule was important to do.
It was certainly spurred by that, Paul. There were cases because the merger compensation is disclosed within NCUA, is disclosed internally, and you look at these numbers. And again, I'm a market guy, I'm a deal guy, I'm an M&A guy. So if you want to pay a bonus, you know, that's not really my business as long as it doesn't create an unsafe and unsound situation. The question is that should it be disclosed? In other words, would a member in voting on a merger consider that information to be material in making the decision whether or not to vote for or against the merger? If the member would consider it to be material, then it should be disclosed. Again, coming at this as someone who practiced securities law for a long time, that's the standard of materiality. And we made the determination within the agency that, yeah, let's disclose it. And if members consider it material, then they'll take it into consideration in how they vote. Because after all, the merger compensation is not pulled out of the sky. It actually comes from members' pockets, directly comes from members' pockets. So you're really voting to use your money to do something. Now, from my perspective, I think there are plenty of compelling stories that can be made that we want to pay Mary or Bob a bonus. Mary or Bob took this credit union, built it, were probably underpaid for many, many years, and they built it into a bit of a juggernaut. And so to pay them a bonus makes a lot of sense. Again, that's the private sector, how it works. You reward people for hard work, but also when people are voting, you give them the facts.
Great, fantastic. Okay, we're getting towards the end here. Let's see if we have any other questions. Okay, Jim.
The question I have is related to the 1/3 regulatory review. Not necessarily speaking to right now, but historically, it's always been, you know, as the NCUA, we review 1/3 of our regulations a year, and in the beginning of the year, we put out a list of the ones we're looking at. If you have any things you think should be discussed, send something to, I believe it's a general counsel's office. And historically, you then never really heard anything after that said, hey, which ones are we going to look at? Why aren't we going to look at them? Did we receive any comments that were of any value or made it worth looking at? I just throw that out. Is that still, does the board get something from general counsel or whatever? Like, where are we at, or how does that process work?
Yeah,
quickly.
That's the way it works on paper, but Jim, I've also, now, we have a board that's ready, willing, and able to address those, so let's address those. It works all the way to the fourth bucket, are the ones that are very expensive. And expensive not just to NCUA, but also expensive to the credit union community. And there's not much for a bang for the buck. So those are the ones that are going to be handled down the road. So we've taken this one-third, one-third, one-third business, we've taken Agrippa, which is another regulatory approach, and we've come up with yet a third one. And the one that I'm going to be focused on is the regulations in this first bucket, the ones that are, hey, these are easy to fix, doesn't cost much, big bang for the buck, let's get this stuff done and actually make some progress.
And actually you have one out now, right? You compiled a lot, and I think the
Yes.
problem is a lot of those don't get headlines to what you're talking about, Jim. People don't pay attention to them. So we know the comment period's due in November. We're going to comment on them. But I think there was a number of regs proposals in that one proposal.
Yeah, there is, and those are in the Federal Register. So, I mean, this is not like something that, I have in my back pocket or something like that. No, this is published out for everyone to read, everyone to think about, everyone to comment on.
Fantastic. Ray.
Thanks, Paul. I listened to the budget ideas, and I wonder if there's something that could be resurrected again. Taking a look at the credit unions, large credit unions, and the extended exam cycle, is there any thought to taking a look at that? When I think of a billion-dollar organization, I don't think of it as a big organization, and that number seems small. Any thought of looking at that again and extending the exam cycle?
Yeah, there is certainly some thinking about it from my perspective. You run into some issues with respect to comparability to FDIC and the like. So it's under consideration, because first time through when this was proposed, I couldn't understand why there was this $1 billion number, because a $1 billion institution, although substantial, is not J.P. Morgan Chase. So, yes.
Great. Terrific. Well, Mark, I want to thank you for the real frank dialogue and giving us the direct messaging on the Corporate Stabilization Fund. It's been a challenge to communicate this to credit unions because, as you said, it's very, very detailed, complex, complicated, and credit unions are busy running great shops, right? So hearing it directly from you today, I think, clarifies a lot of things. So I really, really appreciate that. I appreciate the open dialogue, and we'll certainly continue to feed you ideas. I'll be at the budget hearing next week. Hopefully I have some good ideas for you. Puts a little pressure on me saying there's no ideas coming, so we're going to try to find some good stuff for you guys. But really appreciate it, and I want to give Chairman a big round of applause for his time today.
Thank you. Thank you. Thank you.